And now, live from the Macon studios of News Talk 940 WMAC, it's Your Money.
Good morning, Middle Georgia, and welcome to Your Money. We are Randy and Sherri Goss with Rosenberg Financial Group. As financial advisors, the main thing we do is provide retirement planning advice and manage our clients' investment accounts. So if you're looking for an investment advisor, please contact our office to set up your complimentary consultation. Our office number is 478-922-8100, and we have offices in Macon and Warner Robins for your convenience. To find out more about us, visit our website, retirerelax.com, where you can download and read a number of special reports and listen to past radio show broadcasts. And you can sign up to receive digital feeds, which provide great, relevant information in a short video format. We also offer free seminars on a variety of subjects. And if you're in need of a guest speaker for your civic organization or a church group, give us a call and we'll connect you with Sherri or Jonathan to discuss the details. Today's show is pre-recorded, so you can't call in today. And if you have questions and you'd like for us to cover on a future broadcast, email them to me at randy@rfmoney.com, and we will take care of it and cover them later. As always, you can find out more about Rosenberg Financial Group by visiting our website, retirerelax.com, where you can find a lot of really great information to help you manage your financial life and prepare for retirement. While you're on the website, under the Other Resources tab at the top of the page, click on the Useful Links, and you will see links to CNN, TheStreet.com, The Wall Street Journal, Forbes.com, Barron's, and Fortune. These publications are there for you to read for free. There are financial calculators from Kiplinger's and a few other interesting and informative links. Well, Fortune wants you to subscribe now, so don't bother with that link. We put a lot of work into our website, and we hope that you can enjoy it and use it. The theme for today's show is how to improve your financial life next year and prepare yourself for retirement. Most people make New Year's resolutions or have at some point in their lives. Do you make resolutions? How successful have you been with those resolutions? And will you make a resolution or two for 2024? Hey, Sherri, do you have any resolutions you would like to share?
Sure. I just want to keep going to the gym and eating healthy. Thanks to Pinterest, which is free, I've been able to find and cook tasty, healthy recipes without getting into a food rut. Those two things have been a big deal for me this year, and I plan to continue next year.
I agree. Basically, we are carrying our 2023 resolutions into 2024. The gym is a wonderful event in our week that we look forward to. Our 3 times per week with our trainer keeps us in shape, but also helps us to decompress. When you're in the gym with a trainer, there's no time to think about anything else but what the trainer has you doing and breathing. We have been doing really good at keeping our 2023 resolutions. So let's briefly discuss the history of New Year's resolutions. The ancient Babylonians are said to have been the first people to make New Year's resolutions some 4,000 years ago. They were also the first to hold recorded celebrations in honor of the new year. They held massive 12-day religious festivals known as Akitu. The Babylonians crowned a new king or reaffirmed their loyalty to the reigning king. They also made promises to the gods to pay their debts and return any, quote, borrowed items. Then later in history, the first day of the new year became the traditional occasion for thinking about one's past mistakes and resolving to do better in the future. And in 1740, the English clergyman John Wesley, who founded the Methodism religion, created the Covenant Renewal Service, most commonly held on New Year's Eve or New Year's Day, also known as the Watch Night Service. They included readings of Scripture, singing hymns, and making resolutions for the coming year. Moving forward to today, many of us are conditioned to associate a new year or a new beginning, and the tradition of making resolutions are more rooted in our need for social connection, media influencers, and most importantly, a better understanding of ourselves. We all instinctively understand and grade ourselves, and the result is a creation of resolutions to improve ourselves in the areas we believe need attention. Whether it is losing weight, reducing debt, volunteering in the community, or taking a trip, which is just to name a few, the list of possible resolutions is limitless and very personal. Statista.com reports that America's New Year's resolutions for 2024 are to save more money, exercise more, eat healthier, spend more time with friends and family, lose weight, reduce spending on living expenses, spend less time on social media, reduce stress on the job. While all of these are great goals, the top 3 resolutions are save more money, exercise more, and eat healthier, and they take the lion's share of the survey. But making a resolution is simple. It's like making any declaration to complete or improve something. However, the real work begins after you make these goals. How are you going to accomplish the goals you have set for yourself? That is the question you need to address. Setting goals or resolutions for the new year is a personal choice. It offers a fresh start, a motivation, and a structured focus. However, it can lead to unrealistic expectations, inconsistency, and self-pressure, and even disappointment.
Right. And the one thing you don't want to do is put undue pressure on yourself in the beginning. Many people, when they try to diet, cut out everything bad all at once. They go from 3,000 calories a day to 1,500 calories a day, and within a month, they quit. Why? Because they set unrealistic expectations for themselves. A better way to accomplish this task is to first consult an expert. There are many great forums that can provide good information on how to execute a good diet plan to prevent failure. Personally, I've used the MyFitnessPal app for years. You can download it on your phone for free and track everything you eat, drink, and do daily, so at the end of the day, you can see the nutrients and calories you consumed and the calories you burned. You can subscribe, but I don't recommend it, and I never have. My favorite thing is I can load a recipe into it, including how many servings it provides, and just click on a serving as I eat it, and it automatically loads all the nutrients and calories into my day, so at the end of the day I can see the total results of the choices I've made. And we've used this a number of times just kind of to get back on track if we got a little sloppy,
right,
because it helps you have some accountability to yourself. And it's so easy to use.
And that's what the goals are all about, accountability. And the same thing goes for changing your spending habits. And since this show is about your money, let's assume your New Year's resolution is about improving how you manage your money, your financial future, and your financial success. I would tell you there are many ways to start your trek to financial success and financial independence. The biggest part is to believe in yourself, believing that no matter what your resources are, that you have a degree of control over how you allocate them and prepare for a successful retirement. There are a lot of stories of people who worked in low-skilled jobs who retired wealthy, and those who worked in the highest levels who retired broke. It's not about what you earn, it's about how you spend and what you save.
So Ronald Reed, an ordinary guy by all accounts, is an example. He retired as a gas station attendant and janitor for a local school. He amassed almost $8 million. He left the majority to his local hospital and library, and I still remember that story.
Yeah, he left a mark on his community.
Yes.
On the other end of the spectrum is a well-known name, Mickey Rooney. Throughout his life, he earned millions, but at the time of his death, he was broke and owed money for taxes and medical bills. To help with accomplishing this goal, there's an acronym called SMART, which stands for Specific, Measurable, Achievable, Relevant, and Time, which you can use to help guide you in setting and achieving your goals.
So let's discuss SMART. S stands for specific. Your goal needs to be specific and it needs to be clear. If your goal is to save more money or get out of debt, then these can be easily broken into specific pieces. If it is to save more money, then create a statement that sounds something like this. I will save $100 per month in a savings account that I will not touch for any reason other than an emergency for 1 year.
And if it's to get out of debt, it could sound something like this. I will pay an additional $100 per month on the bill with the highest interest rate. These statements don't need to be wordy and long. They need to be simple and direct. Next is measurable, or M. Having goals that are measurable is a wonderful way to be able to determine if you've met your goals at the end of a specific time frame. Then you know if you're on the right path, whether you're going in the right direction. If your goal is to have saved $100 per month for a year, then at the end of the 12-month, your measure of success would be how close you are to the $1,200 goal. If at the end of the 12th month you've just saved $1,000, did you fail? I would say no. But at this point, you need to ask yourself why you did not meet your goal. Was it because you had an unforeseen bill, such as a auto repair or a medical bill? If so, then paying that instead of incurring the debt may have been the wiser option. And in this case, if you saved the $1,000 instead of the $1,200 goal, then you are still 83% closer than you were before you started. You could give yourself a strong B as a grade.
I agree. So A is for achievable. And another way to say this is the goal realistic. We can all set goals, but if they are unrealistic, what is the point? You and your own brain will know that there is no point in even trying if the goal is not achievable. They should not be impossible. For example, if you have a $50,000 balance in a credit card debt and earn $70,000 a year, it is impossible for you to pay the entire $50,000 off in 1 year. However, could you break this goal up into, say, 7 years? Then it changes from an improbable to probable and achievable. And next, there is relevance, the R. Relevance refers to focusing on something that makes sense with a broader sense within your life. In business, this would be like launching a new product or service. You would want this new product to align with your existing business to complement it. For you personally, saving money and getting out of debt is the ultimate alignment of processes. Getting rid of debt enables you to live a less stressful life. It could enable you to be more philanthropic, save for retirement, and possibly retire earlier and just be a better, more relaxed you.
T, the last letter in SMART, stands for time. Anyone can set goals, but if it lacks realistic timing, chances are you're not going to succeed. Providing a target date for deliverables is imperative. You need to ask specific questions about the goals, deadlines, and what can be accomplished within that time period. If the goal will take a year to complete, it is useful to define what should be achieved halfway through the process. Providing time constraints also creates a sense of urgency. Additionally, if you don't want to let the processes drag out forever, set a target date and then set milestones to check yourself throughout the process. Don't set the review dates too close together. Give the processes you have set in action time to work. Basically, time for the seeds that you have planted to start bearing fruit. At the end of the time period, review your progress and decide where you need to adjust your goals to either do better or move on to the next set of goals. SMART is but one example. Stephen Covey wrote a book titled The 7 Habits of Highly Successful People, which provides a framework for developing healthy habits to make you a more prosperous and effective individual. I suggest reading or rereading this book as a sort of a booster shot if needed.
So his writing is just amazing. If you go to franklincovey.com, you can read about the 7 habits for free. Then if you want the book, I suggest you go to Gottwalls or call them up first and see if they can source a copy for you, because they're used and they are a really good deal.
Agreed. Okay, we have roughly discussed the history of resolutions and how to move from one resolution to action and then realization. Let's specifically discuss debt and retirement. First, saving for retirement can be difficult if you're buried in debt. There is no doubt that at some point people just give up trying to pay off debt and saving for retirement. I have a friend, and you've heard me mention him many times. He's a very talented person and has a very diverse set of skills, from law enforcement to a professional fisherman to a security expert for a Fortune 500 firm. He holds a U.S. patent and also holds way too much debt. He admittedly said to me that he could never retire and that he would work until the day he died. I talked to him until I was blue in the face. I gave him the solutions and begged him to follow my advice. We had these conversations for years, and it was like talking to a goat. Then one day he calls me and basically says that he had a great idea and basically repeats everything I've been telling him. I sat there with my mouth hanging open in stunned amazement, and then I told him he was a genius. I took the balances of each of his bills and put everything on a spreadsheet. This showed him how he could pay off each of his debts, starting with the lowest balance, and then add the payment he was making to the next bill. Using that process for each successive bill and ultimately getting down to paying off his home. The process is known as the snowball method, and Dave Ramsey made this famous over a decade ago. Now he is about 1 year into the process, and everything could be paid off in about 6.4 years. Then he could put the money that he had been using to pay off his debts into savings for retirement. So the moral of this story is not to give up on paying off your debts. Get advice, get smart, and get dedicated to the process. If you got into this sort of mess, there should be a way to get out.
Before we move on, let's discuss emergency savings. You know, as they say, life happens. The roof is leaking, or the car breaks down, the kid is sick again, or you're laid off from your job. An emergency fund can relieve some of the worry and stress that you will have about how you are going to pay the bills or put food on the table. An emergency fund is money you set aside for these life events that you know will happen, but you just don't know when they will happen. but as they seem to happen at the worst possible times. Having cash available means you can quickly take care of the emergency situation and be able to get on with your life. It brings a certain peace of mind. According to a study by Dave Ramsey, 54% of Americans worry daily about their financial situation, and 34% of them have no savings at all. That is enough to keep anyone up at night, especially if you have children. But you don't have to live like that. An emergency fund can help provide that peace of mind. If you still have debt, you should create an emergency fund with $1,000, according to Ramsey. This will somewhat insulate you while you pay off debt until you can fully fund an emergency fund.
The question is, how much should you set aside for an emergency fund? Experts in general recommend 3 to 6 months. If you are single with no kids or married, and each of you have a stable job, then 3 months is the target. If you're married with a single income, a single parent, or have a job that is seasonal or self-employed, then the recommendation is 6 months of expenses.
You should keep this money in a simple savings account that is easily accessible in the event of an emergency. If an emergency were to happen over the weekend, you don't want to wait until Monday to have to access these funds, so be sure you have access through a debit card or other ability to transfer the funds to a checking account. We will discuss budgeting in a few minutes. This exercise will enable you to identify areas where you can save money in your household, and hopefully you can use that money to create an emergency fund account. In the meantime, let's discuss the difficulties youth are having with their efforts to save for retirement. A report by CNBC highlighted that increased rent, credit card bills, student loans, and even social media made it more difficult for younger people to save for retirement. Allianz argues peer pressure on social media is part of the problem. The study, which examines social media's impact on American spending habits, found that nearly 90% of millennial respondents say social media creates a tendency to compare their own wealth or lifestyle to that of their peers. That's compared to 71% of those in Generation X and 54% of baby boomers who say the same.
And a lot of time these peers are not even people they actually know. They are the AKA digital friends, where everything looks good for the camera. No one is showing you their checkbooks or their stack of bills. Granted, some may have it all under control, but we all need to walk our own path and not be led down someone else's. A lot of it has to do with FOMO, which is the fear of missing out. Whether it is a new hot item or a destination trip, people are willing to lay out cash for these items instead of investing for their retirement or even setting aside funds for an emergency. These tendencies to splurge based on what people are doing that they don't even know can have long-term negative effects on people's finances if they're not careful. For some reason, a lot of young people, not all, think that they have to have everything new. And we think social media has caused a lot of this. A new house, a new car, new furniture, etc. The result is debt and a huge financial burden. The problem is that if you take on debt before you're ready for it, then you could be in for a lot of trouble. What happens if your AC goes out or an uninsured medical issue occurs, and then you have to finance those bills too? Pretty soon you're overextended and living on the financial edge. Unless you had the foresight to set aside funds for an emergency account, you could be in financial trouble, and this could happen quickly. The alternative is changing perspectives, and in the management world, we call this changing paradigms.
So let's shift the conversation to retirement accounts. So what is your retirement plan? Do you have multiple accounts from different jobs? If so, it can be hard to keep up with all of them. Do you understand the investments that you're purchasing in your current plan? Do you know how much you'll have to save to replace your income in retirement? Have you gone to the Social Security website and logged in to see your potential benefits? Let's talk through all of this. First, the multiple account problem. Some plans encourage you to combine all of your retirement plans into your current plan at work. But what if you don't really understand the investment options in the plan? This is a big problem that we hear from a lot of people because most company plans do not send in a rep every year to meet with employees to review their time horizon to retirement or to help them select investments. Here are some tips regarding retirement plans. If your current plan does not offer in-person visits from a plan representative, mark your calendar to call the 800 number every year and have a review with your retirement plan advisor. For the accounts that are outside of your current retirement plan, call us and make an appointment so we can review the investments and assist you in making recommendations that best meet your needs. Understanding plans and the multitude of investment options can be confusing. This is why we offer complimentary consultations. Call our office at 478-922-8100 to schedule your complimentary consultation, then print out your plan details which show the investment options and also what you are currently invested in. You should bring these with you when you come in for your appointment with either me or Jonathan.
And if you have an old workplace retirement account and you'd like to consolidate them into one account, we would be happy to discuss this with you. We can also run a financial planning that is customized to your specific situation. These financial plans are a great way for you to set a baseline with projections of where you could be by the time you get to retirement. A financial plan, when reviewed annually with your financial advisor, is a great way to see how you're doing with regard to achieving your goals. And before we go on, you've been listening to Your Money with Sherri and Randy Goss with Rosenberg Financial Group. As financial advisors, the main thing we do is provide retirement planning advice and manage our clients' investment accounts. So if you're looking for an investment advisor, please contact our office to set up your complimentary consultation. Our office number is 478-922-8100, and we have offices in Macon and Warner Robins for your convenience. To find out more about us, visit our website, retirerelax.com, where you can download and read a number of special reports and listen to past radio show broadcasts. You can also sign up to receive our digital feed, which provides great relevant information in a short video format. We also offer free seminars on a variety of subjects, so if you're in need of a guest speaker for your civic organization or church group, give us a call and we will connect you with Sherri or Jonathan to discuss the details. And thanks for listening. So back to the show. Well, here are some tips from a special report that's on our website, which is, again, retirerelax.com, titled, Can I Afford to Retire? And you can print this report out for free, and it's very helpful. When we first meet with pre-retirees, we always want to get an understanding of their overall financial situation. What will the income be in retirement? Will it be enough to cover their expenses? Will they have a pension? How much will they have saved? Do they have any debt? What will their medical insurance situation be? How is their health? When will they apply for Social Security? And how can they maximize those benefits? These decisions to retire is huge, and it should not be taken lightly. Unfortunately, we often see people who have a, quote, I am tired of working and I want to retire frame of mind. And this is dangerous because they are making a life-changing decision based on how they feel at that moment. Instead of making this financial decision based on emotion, we need to make the decision based on facts. To help you make the best decision, let's walk through some of the questions we would ask if we were meeting with you in person. What will your income be during retirement? First, you will need to gather some figures. Do you know what you will receive from Social Security? If you're not sure, you should go to the Social Security website, which is ssa.gov, and create a My Social Security account. This enables you to see what your current benefit information is.
How do you make the best decisions concerning Social Security? When we ask people why they took Social Security benefits, they say, I paid into it, and if I don't take it now, I might not live long enough to receive what I've put in. Or they say, I want to enjoy my money now in case I don't live too long. But you should think of Social Security as a long-term plan. It was created as a supplemental income plan. Social Security is one stream of income for many retirees. If you have other investment accounts, you could have a stream of income from those accounts as well. If so, we encourage you to not plan on taking out more than 3 to 4% per year. As an example, if you have $200,000 saved, 4% of that is an $8,000 annual gross distribution. So your monthly gross income from your retirement account would be $667. If you will receive a pension, you need to request an estimate from your company's benefit office. The closer you get to your retirement date, the more accurate that estimate will be. And if you are married, please consider the survivor benefit.
And after you've added the various streams of income from Social Security, pensions, investment accounts, rental income, and so forth, what is your total expected monthly fixed income in retirement? And how does this compare with your current income? If it will be much less than what you're earning now, how will you make this work? Your choices are either to reduce expenses by paying off debt before you retire, or reduce expenses, aka reducing spending during retirement. Of course, you could continue to work. To help you with this decision, we have more homework for you, but we'll get to that in just a minute. Yet another factor to consider is inflation. It is very possible that you might be retired for as many years as you have worked. Just think about what it would be like if you were given a salary at, say, age 25, and that salary never increased. Think about how much the cost of everything has gone up, especially in the last few years. How would you adapt? That would probably be an adverse effect on your lifestyle. If you eventually have financial problems, it will be in your later years. Too many people plan for what they want now, but the real issue is what happens when you get older. The cost of living has gone up because of what you can't make ends meet. At that point, you would probably wish you had handled your Social Security benefits differently. Remember, your biggest problem isn't that you'll die too soon and miss out on potential benefits. Your biggest problem is that you're going to live too long and run out of money. Oh, and don't forget, for every year you defer taking Social Security up to your full retirement age, you earn an additional 8% on the amount that you would receive.
Okay, so here is your homework. At the end of this report, you will find our spending tracker. It's critically important to know where your money goes. The tracker will help you do that. Print it out, put it in a place where you will see it every day, and have a pen handy. January is a great month to do this, as it gives you a fresh start to the new year. Every day, for a month, write down every dime you spent, whether you used cash, a credit card, or a debit card. Do it for 30 days or the entire month. You might be tempted to do this on your computer or a phone app, but there is a benefit to physically writing this down.
You know, I used to object to you on this. I used to want to put it in the computer system, and I found that I just didn't look at it and analyze it like I would if it was laying on the kitchen counter. So I 100% agree with you.
Writing what you've spent creates a new habit of awareness in your brain. This new awareness gives you a better shot at changing habits. You could find there are some spending habits that you need to change even before the end of the 30 days. At the end of the 30 days, I bet you will be surprised to see how much you spend on certain items. You may know you buy coffee on the way to work every day, but you may not really know how much you spend in total. These ancillary expenses eat away at budgets, and this exercise is a great way to see where your money is actually going. Once you've tracked your spending for 30 days, evaluate your choices. Should you spend less in one category and more in another? Could you use the money you were spending on an ancillary expense to pay off credit card debt? To build an emergency savings account? These are just good examples that can assist you in reaching the goals you set for your New Year's resolutions. Granted, it's possible and probable that you might not have some of these expenses once you retire. You probably won't spend as much money on clothes, lunches out, or gas. However, you will have other expenses. For example, your medical expenses will probably go up. So might travel expenses. It might be a good idea to do this annually and to continue to do this after you retire to help you stay on track. And I want to make a note here. So we used this spending tracker for years as the kids were growing up, and we set financial goals at the same time. Every January, financial goals track spending for a month, and it made a massive difference in helping us rein in spending where we were getting sloppy. And so you may think that you're doing everything right, but you might be shocked once you see where your money's going because you're not aware, because you're using a credit card and a debit card all the time, which your brain does not register.
And it becomes easier to not do this the more money you make.
Yes.
But if you're making more money, think about what you could be doing with that money if you streamline your expenses. So
Really,
anyway,
absolutely.
So far you've calculated what your income will be, and you're going to track your spending to see where your money is going. Now you've already read about what inflation can do to your purchasing power, and you've learned tips on maximizing your Social Security. What can be left? Projecting future growth of your investments. Many planners use retirement calculators, and you can find them all over the web. They ask you to input your current information, which is pretty straightforward, but you need to make a number of assumptions like life expectancy and your assumed rate of return. This is where it gets a bit dicey. Obviously, you don't know how fast your money will grow between now and the rest of your life.
You must be careful here. Be conservative. I suggest using a rate of return of 4 to 5% to take into account that there may be rough years, like the last two that we just are now coming out of. We've never seen a calculator that really works, no matter what some people would lead you to believe. The reason is we have no idea what next year will bring. If you base your retirement on false assumptions, then you may be doomed to run out of money. You need to look at this logically and with some common sense.
You know, the single greatest fear that retirees have is running out of money. So let's look at several factors that might give you some insight as to whether you can really afford to retire. The first, and probably one of the biggest, is if you have a mortgage with more than 5 years to pay off. We tell everyone who listens that retiring with a mortgage makes retirement more difficult. Your mortgage is probably the single biggest monthly expense you have. Think about how much easier it would be to secure your retirement will be if you didn't have this payment. The same is true if you have a substantial credit card or an automobile debt.
Another big factor is whether you're supporting other family members. It is a fact that more parents and grandparents are supporting their children and grandchildren than in previous years. Face it, retirement is difficult enough just supporting yourself, especially if you live a long time. If you choose to support other family members, you are taking money away from yourself and making it more likely that you will run out of money. As author and economist Tom Sowell says, you cannot subsidize irresponsibility and expect people to become responsible.
That is a true statement.
Yes. The more money you give to family members, the more they will expect. That means less money for your own retirement and a greater possibility that you could run out of money. Ask yourself, will they support me if I use up all my money on them? You probably already know the answer.
Logic tells us that if you have not saved enough for retirement, you may not be able to retire. A financially secure retirement doesn't happen by accident. It takes planning and it takes discipline. It means foregoing certain luxuries. Spending that money while you're working, such as much fun as it may be, can jeopardize a secure retirement. Starting early is a good way to secure a good retirement. Emergencies happen, and if you're unprepared, you will be dipping into your investments more frequently than you would like, or you will have to go into debt. Set aside a sum each month for home and car maintenance, as well as to cover unexpected medical expenses. Another big issue we see when spouses disagree on spending and saving, this creates a very stressful situation. You want to spend and your spouse doesn't, or you want to save and your spouse wants to spend. Either way, you're in conflict and not focused on the same goals. Finding a happy medium is very important. Don't think it needs to be 100% your way or the other way. We have seen families that are so opposite with money that they will not commingle their money for anything. They will go to the grocery store and split the bill at the cashier. They split every bill, and everything is a negotiation. This particular family is getting on the right path now, but the tipping point happened about 5 years ago when one of the adults came home with a brand new shiny vehicle that they could not afford. They are still married, luckily, but it was not a fun time for them for a while. Another big issue is if your spouse opts out of survivor's benefits. We meet a lot of widows whose spouse expected to live a long time but didn't. Because they expected to live a long time, they did not apply for survivor's benefits when taking their pensions. Now, the surviving spouse is living on one stream of income, which is the higher of the two Social Security checks, instead of living on three streams of income, which could have been two Social Security checks and the pension. We would be remiss if we did not discuss long-term care. In recent years, insurance carriers have come up with more efficient ways to protect people against long-term care expenses. And we've come across several carriers that offer hybrid policies such as life insurance or annuities that also insure for long-term care. A traditional long-term care insurance policy works like any other insurance policy. You pay premiums, most of the time into perpetuity, and in the event that you have a claim, say for nursing home, in-home care, respite care, etc., it would pay a stated benefit. The problem now is that cost of care, long-term care insurance has become cost prohibitive for the average person. Well, if you've never ended up needing any form of long-term care, that is a lot of money to spend for just in case. Many life insurance policies now have added protection built into them for long-term care needs. This usually is referred to as an accelerated care benefit or something similar. This means that for qualified long-term care expenses, a portion of the death benefit can be accelerated and used while the insured is still alive. At some carriers, this portion of a death benefit is available can be as high as 90%. This is mostly only offered on permanent life policies such as whole life or universal life. So let's just say you have a policy, a whole life or universal life, with a face amount of $500,000. With accelerated care provision, you would have access up to $450,000 or 90% for a long-term care expenses. This is caught on pretty favorably in the industry because most people have and believe in life insurance, and since permanent life insurance doesn't expire, it will definitely pay a claim to its beneficiaries one day. If you have some form of long-term care protection built into your life insurance policy, but you never end up needing the care, it will still be a life insurance policy at the end of the day. It will pass to a beneficiary. It will pass a benefit on to your loved ones. If you have a life insurance policy that you have had for a long time and it has a meaningful amount of cash value, this process may be even easier for you. You have the option to transfer that cash value into a new policy that has this long-term care provision in it. And when you utilize this method, it can significantly reduce your out-of-pocket expense for the new policy. This is called a 1035 exchange, and it's a tax-free transfer of cash value from one policy to another. Over the years, Jonathan has helped a number of clients move out of existing policies into new ones that is better suited for their needs. Whether the purpose is to increase coverage, reduce premiums, add benefits, or some combination of all of that, it's certainly possible by way of a 1035 exchange. Now, if you have an existing policy and you'd like to explore these possibilities, give us a call at 478-922-8100 and ask for Jonathan. Okay, shifting gears. It's been fun to discuss investing with your friends and coworkers, but be careful who you take your investing advice from. Personal coach Tony Robbins says it's easy to be successful. Just find someone who is successful and do the same thing that they're doing. Unfortunately, too many people end up taking advice from people who are broke and in debt. Why do they do it? Because they will hear the answer that they want. Now, I'm sure that these people are filled with good intentions, but most of them are not in any position to give financial advice. Many of these people are living paycheck to paycheck. They have accumulated little in the way of investments or retirement funds, and they are up to their eyeballs in debt. Yet they are giving you financial advice, and you are actually listening. You are the one who will suffer. Recently, on a previous broadcast, we discussed that many people are getting financial and tax advice from social media. This could be a big mistake. Influencers get paid if they generate clicks, and this is what they are after because that is how they get paid. So, in many cases, the information that they provide comes to you in less than 3-minute segments, which does not provide enough information to cover all of the facts.
I strongly recommend you reach out to a trusted certified financial planner or CPA when it comes to investments or tax-related issues. The cost to unwind some of the mistakes influencers cause could be greater than the cost of the advice of the CPA or CFP. Plus, you can create a local relationship with these professionals that you can use for years to come.
The bottom line is, focus on building wealth. Building wealth strategy requires strategy and time. And if you're still in the accumulation years, meaning still working, you need to be investing in your company's 401k if they have one. And be sure you don't leave money on the table. Meaning, if the company offers matching funds, make sure you match the amount they're willing to contribute. If your company does not offer a retirement or investment options and you would like to explore investing through our company, please give us a call at 478-922-8100 for a complimentary consultation. We can explain the options available, and if you are close to retirement or have retired and are looking for a financial advisor, we would love for you to consider us. And again, our number is 478-922-8100. Remember, borrow thoughtfully and regularly monitor your accounts. And before we move on, I would like to comment on credit scores. Low credit scores are like a thief in the night because if your credit score is not high, then you're paying higher interest rates on everything you finance, and it's a great time to make a resolution to fix it.
The following is from Clark.com, which is Clark Howard's website, and the article is titled, Credit Bureaus Announce Big Changes for Credit Reports. Regularly reviewing your credit report is a great way to keep tabs on your financial well-being, and it has become a little easier. For a few years now, all three major credit reporting bureaus, Equifax, Experian, and TransUnion, have been making free credit reports available on an annual basis at annualcreditreport.com. Then, during the COVID-19 pandemic, the bureaus began making credit reports available for free on a weekly basis, which was an arrangement set to expire at the end of 2023. Now, the bureaus have announced that they are extending free weekly credit report access to consumers permanently. To access your free credit report, go to annualcreditreport.com. For example, you can click TransUnion, and you'll be taken through the process to view your credit report with that agency. You can use the menu to move to another agency credit report.
And please put the credit report review on your calendar. A credit score is a prediction of your credit behavior, such as how likely you are to pay back a loan on time based on the information from your credit reports. Companies use credit scores to make decisions on whether to offer you a mortgage, a credit card, an auto loan, or other credit products, as well as for tenant screening and insurance. They are also used to determine if insurance or interest rates and credit limits that you receive. The credit score is a mathematical formula called a scoring model derived from information in your credit score. What factors affect your credit score? Your bill paying history, your current unpaid debt, the number of type of loan accounts you have, how long you've had an account, loan accounts open, how much of your available credit that you're using, new applications for credit, whether you've had a debt sent to collections, a foreclosure, or a bankruptcy, and how long ago. You do not just have one credit score. Each credit score depends on the data used to calculate it, and it may differ depending on the scoring model, which itself may depend on the type of product the score will be used for, the source of the data used, and even the day it was calculated. Usually, the higher score makes it easier to qualify for a loan and may result in a better interest rate or loan terms. Most credit scores range from 300 to 850. And if you've got one as low as 300, you're probably not getting credit other than at a payday loan. There are several ways to get a credit score. If you applied for a residential mortgage loan and the lender uses your credit score, the lender will send you a notice with the credit score. You could receive a score if you were turned down on an application like a cell phone or a utility bill as well.
Many major credit card companies and some auto loan companies have begun to provide credit scores for all their customers on a monthly basis. The score is usually listed on your monthly statement or can be found by logging into your account online. By using a credit score service, many services and websites advertise a free credit score. Some sites may be funded through advertising and not charge a fee. Other sites may require that you sign up for a credit monitoring service with a monthly subscription fee in order to get your free score. These services are often advertised as free trials, but if you don't cancel within a specified period, which are often very short, like 1 week, you could be on the hook for a monthly fee, so watch out. Before you sign up to try one of these services, be sure you know what you are signing up for and how much it's going to cost. And honestly, I would not do it. I would only use annualcreditreport.com.
Now, you can buy a score directly from a credit reporting company, and you can also buy your FICO credit score at myfico.com. If you decide to purchase a credit score, you are not required to purchase credit protection, identity theft, monitoring, or other services that may be offered at the same time.
So I went online and pulled my credit report, and it was very easy. You enter your personal information, then you have to get a code on your phone. You enter the code, and you are in. At the end of the credit report, there is a lot of helpful information about identity theft. So please take a moment to read that, because we're seeing this becoming a bigger problem than I've ever seen in my lifetime.
I agree, and I'm glad to see that they have taken this from once a year down to weekly, or is great. So what if you work through all this stuff, Sherri, that we've just talked about, and you still see that there's no way for you to retire? Then what are your options? Well, I truly hope you don't find yourself in this situation, but it does happen. Identifying the situation as early as possible is a great first step. One of the best solutions is, as we previously said, is to continue working a little longer. And while you are still able, you could start a side hustle and moonlighting in your spare time can not only help your budget, it can also lead to a better job down the road. Or if you're doing well, you may find it time to take a leap and go full-time with your own business.
There is such an employee shortage that I would suggest looking at local tech schools and the high-demand career fields that are paying a premium right now. Switching careers might be the answer, especially if you are burned out on your current job. The bottom line is, don't paint yourself into a corner by retiring too early because you just don't like your current job. And I want to throw in something we didn't put into the show. Central Georgia Tech has 18 career fields right now that are absolutely free for you to go through. And you could work full-time and go to school on the side. Then it could change your life. Anyways, so we're running short on time, but I want to briefly cover a few other things before we close out. First, be sure to create a will, power of attorney, and advance directive, and here's why this is important. If you are the sole owner of property, it will pass by the will. And as a side note, I saw somebody just today whose wife did not have a will. She passed away, and he had to wait 3 years to get that property placed in his name and hire an attorney.
And let me throw in here, too. If you do create a will and you put it on a thumb drive, make sure that someone knows where the thumb drive is, and if it's password protected, someone knows how to get into that thumb drive.
Yep. And you really need a printed copy that's notarized, and you need to have it in a safe place. I encourage you to have a safe, possibly, to put things like that in. But anyway, so if you're the sole owner of property, it will pass by the will. Here's a story to help you see why this is important. I was presenting a lifebook program for a group, and when I got to this section of the program, a woman stood up and said, "Let me tell you how important this is. My husband and I lived in a house that was in his name alone, and he didn't want to make a will. I badgered him to the point where one day he finally said, 'I got the will made, and it's on the computer.' I trusted him, so didn't look at it, and not much later, he died, unexpectedly. We go into the computer, and he had saved a will, but he never signed it, so he died intestate. And he had 2 sons from a previous marriage, so I now own a third of the house, and each of his sons own a third. And do you think that they're going to give me back their 2/3?
No.
No. So get a will made if you own property.
And, it's nice, it's wise to review these on a regular basis as
Absolutely.
As well as reviewing your beneficiaries and other financial documents to make sure that if you pass, that things are going to go as you intended them to go. Because we hear stories all the time that someone passes away and the only will that can be found is one that was 10 years old or something, and those are not the people that others remembered were supposed to get, the China set or whatever. So you got to make sure that you know where these documents are and that they're updated on a regular basis and they're accurate.
And the beneficiary review is a really big deal because you have beneficiaries on all of your investment accounts, life insurance, 401k, all of those things.
Yep.
And a lot of people just never stop to take a look at them. And back when I was in the insurance business and I was signing people up for life insurance, they would, if I had a young man, the young men would always make their mother the beneficiary, and always terrified me that they would possibly never change that because the insurance companies are not going to reach out to you and say, "Do you still want these people to be your beneficiaries?" Nobody's going to do that.
Happens in the military all the time.
All the time. And so please take a look at all of your beneficiaries on everything.
And if you need a will, you can download forms on LegalZoom or Quicken. We helped a friend get wills made for him and his wife, and they bought their first home. LegalZoom was very easy and to use and very inexpensive. Another reason to get a will made is if you have minor children. Who will take care of them if something happens to you? Put this in writing. Now, if you have a really complicated situation, you may want to hire an attorney, and that will be well worth the money spent.
If you need help working through all of this, go to our website, retirerelax.com, and print out the pages of my life book. It's a book I wrote back in 2007, and I update the pages every year, and it will walk you through all the estate planning tasks you need to complete. There's more to it than that, though. If you go to the very back of the life book, you will see a lot of helpful tips about Social Security, Medicare, all sorts of things, and it even includes an advance directive, which we haven't talked about. So let me talk about that a minute. So you can get a free advance directive online, and if you want one, email me, Sherri, Sherri, at rfmoney.com, and I will email the link to the website to you. An advance directive is really important, and we had to have them because you were in the military. It was just part of what we were supposed to do. And what it does is it instructs what you want done if you pass away or if you are incapacitated severely. In the advance directive, you can name someone to be in charge of your funeral, and here's why you would do that. I had a lady come to me, and she said, my sister who is dying wants to be cremated. And my other sister says there's no way she's going to allow that to happen because she thinks it's a sin and wants her to be buried. And so I'm sitting there talking to this lady, and I tell her, I said, then you need to go have her make an advance directive, and in the directive she articulates in writing that she wants to be cremated. And if she has that document and she gives it to the funeral home, they will follow her wishes, not the wishes of a family member that disagreed with her. The advance directive also, another very important thing, is if you were seriously incapacitated, let's say you're in a coma and you're never going to come back to be who you are, do you want to be on life support for as long as you can stay alive, or do you want them to unplug you and let you go? I feel very strongly about this. I don't want anything. If I'm incapacitated to the point where I will never come back to be myself and I would have to be on life support to stay alive, I want to be unplugged. I'm very clear about it in my advance directive, and Randy knows about it, and our kids know about it. There is going to be no disagreement if that ever happens to me.
The same for me.
But you have to realize these situations can happen. This could happen because of a car wreck on I-75, and here your family is sitting there, you're in the hospital trying to figure out should they do. And so it's really important that you complete this document.
We just saw this with one of our employees last month and their family, and it was just gut-wrenching to watch because everyone had an opinion and nothing was in writing. It's just, it can devastate a family. So please take the time to get these documents in place and put them in a safe place. It's just vital for your family.
And let me talk just real quickly about powers of attorney and a case that I had just this last week. So I met with a client. They don't come in very often, and they finally opened up about their personal situation and what's going on. He has living parents. One of the parents has severe dementia. And I said, do you have power of attorney over your parents so that you can help them and get things done for them? No, we never did that. Well, I mean, then he has another situation where another person needs a power of attorney because his son is very sick and they don't even know if he's going to make it. And so you have to think worst case scenario. What's the worst possible thing that could happen? And how do you protect your family and yourself so that the best possible decisions can be made in that time of crisis? That's what you're doing, is you're handling a crisis in advance to make sure that it's not a crisis.
Yep.
So
expect the best, plan for the worst.
So go to retirerelax.com. That's our website. Click on My Life Book, print out the pages, and it'll walk you through everything that you need to do.
Well, Sherri, we're at the end of the show, and we've really enjoyed it, and we hope that you have too. You've been listening to Your Money, produced by Rosenberg Financial Group. So if you're looking for an investment advisor, please give us a call at 478-922-8100, and you can learn more about us by visiting our website, retirerelax.com, where you can read a number of special reports that you can download absolutely for free. The ever-popular Life Book is there for you to download, and we will be back the first Saturday of January, and we hope that you and your family have a wonderful holiday season.
And one last comment. When you go to our website, you're not being tracked. We're not going to spam you. We're not going to email you. You're not going to hear from us. It is completely confidential, so you can feel free to go to the website and look at any of the reports that you want to and not worry about us tracking you down.
There is a little box that pops up that says, if you'd like to receive our digital feeds, put your name and your email in. But if you don't want to put your name in there, just click the X, and that's as far as it goes.
It's a great website, and there's a lot of great information absolutely free for you to help you have a very prosperous financial future.
Well, thank you for listening, everybody, and as always, we appreciate you, and we look forward to reconnecting with you in 2024.
Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Osaic Wealth is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Osaic Wealth.